Now, today we're going to look at how we record business transactions. Last class, you looked at how we analyze business transactions. You recall that a business transaction is an exchange. And a business transaction affects the balance sheet equation, assets equal liabilities and equity. And because it's an exchange, each transaction affects two accounts. So every transaction has to be recorded in two places. And what we're looking at then now is how do we record all those business transactions? You can imagine a number of transactions that take place in one day in one small business. So yeah, we can have a great big spreadsheet like we had last time, and we can increase and decrease and that. But that's not how we do it. It's too cumbersome. We have a shorthand way of doing it. Now, this system was developed over 500 years ago in Venice. And that's why the words we use in accounting and in business are different than normal everyday accounting or business terms, because it's old Latin. Now, if you think of every account and the accounting records as a T across the top, and there's two sides to the T, the left side and the right side. And what you do across the top is put the name of the account, for example, cash. Now, the word debit is old Italian. It simply means left. That's all it means. And credit means right. So when they say debit this account, that is, you record it on the left side of the account. When they say credit the account, you record it on the right side. Okay? And so therefore, you must look at each account as a T that has a left side and a right side. So now let's see how you do with the quiz. Some 12. Sign up. All right, question 1. A T account is a way of depicting a basic form of an account, a special account used instead of a journal, and a special amount account. Yeah, exactly. It's just a way of thinking of each of these accounts. That's all we want to do. It's a way of thinking. All right. Question 2. The left side of the T account is called good. That's right. Question 3. The right side. It's as simple as that. All right, I don't know where the others are. Of course, it's called the credits. All right, now, this is the way in which we record in a double entry accounting system. Keep in mind, each transaction affects two accounts, or it can affect more than two accounts in the balance sheet equation or the basic accounting equation. That equation again is assets equal liabilities less equity. One of the accounts in every transaction will be debited, and the crediting will be done at least to one of the other accounts. If there's 3 accounts, then there could be 2 debits and 1 credit, but they will equal. They will always equal. Debits equal credits. The left side equals the right side. All right. Now, when I look at the account, if I add up the debit side of the account, as we do here, transaction 1 and 3, debited this account, transaction 2 credited this account. If I add it up, on the debit side, I get 18,000, and the credit side, I get 3,000. I summarize that by saying that this account has a debit balance, and that debit balance is 15,000. If, on the other hand, I sum it up and there are more credits in this account than there are debits, then I add them up, 11,000 in credits, 10,000 in debits, subtract them, and because the credits exceed the debits, I refer to this account as a credit balance. That's all I have to do, okay? Now, here are the debit and credit rules. You recall the balance sheet equation. Think of it this way. Assets equal liability plus equity. Think of that equal sign. On the left-hand side of the equal sign are assets. So the rule is, and it's just a rule, the rule is if the account that I am going to record in is an asset account, that is, it's cash, accounts receivable, supplies, or equipment, or prepaid insurance, just like the transactions we did. If it is an asset account, I will record that on the debit side, the left side. That's the only rule. So the assets are on the left-hand side of the equal sign, and they're going to increase by recording them on the left-hand side of the T account. That's that. The liabilities are on the right-hand side of the equal sign. And therefore, if this transaction should increase or be, if this transaction affects a liability account and the liability account increases, we will record that on the right-hand side. So if an asset account increases, we record it on the left side, debit. If a liability account increases, we record it on the right-hand side. Now the opposite is the same. If an asset account decreases, we record it on the right side, the credit. If a liability account decreases, we record it on the left side. We don't do increases and decreases anymore. We simply we record increases in assets on the left side, decreases in assets on the right side. If transaction increases a liability, we record that liability account on the right side. If the transaction decreases a liability, I paid off a debt, I record that on the left side. So you see, debits increase, assets, credits decrease. Liabilities, the opposite. It's on the other side of the equal sign. Liabilities increase by a credit, and decrease by a debit. Now, the same thing with the equity account. The equity account is on the right-hand side of the equal sign. Therefore, we're going to increase the equity account by recording an increase in the shareholders' equity on the credit side, the right side. If there's a decrease in shareholders' equity, we record it on the left side. But with shareholders' equity, you see, it increases when I put in share stock, when I sell stock, all right? And it decreases when I pay dividends. So when I sell stock, I record capital stock on the right-hand side. When I pay dividends, then it's going to be on the left-hand side. Let's go down. Now, revenue also increases shareholders' equity. So shareholders' equity increases on the right side, so we record transactions in which I earn revenue. I record them on the credit side. And there are no transactions that reduce revenue. I either earn revenue or I don't. So there's no negative revenue. So all the time I earn revenue, it's always credit revenue. Now, expenses decrease shareholders' equity. And therefore, expenses are going to be recorded on the left side because the shareholders' equity decreases on the left side. So expenses, we record all the expenses on the debit side. Why? Because debits decrease shareholders' equity. Now, there is never a transaction where you reduce the expenses. So every time you incur an expense, you record it on the debit side. So memorize this. That's all you have to do is memorize this. Again, assets, if a transaction increases an asset account, I will record that increase in that asset account on the debit side. If the transaction decreases an asset account, I will record that decrease on the credit side. It's as simple as that. If a transaction increases a liability, I will record that increase in the liability on the right-hand side or the credit side of the account, the liability account, whatever that account is, accounts payable, bonds payable, notes payable, unearned revenue. Any increases in those accounts, I will record on the credit side. If I decrease the account, the liability, I pay off a notes payable. Therefore, accounts payable is decreased. I record that decrease on the debit side. Equity, if I sell common stock, then equity will go up. I record that on the credit side. If I earn revenue, I record that only on the credit side. If I incur expenses, I record that on the debit side. There are your 5 categories of accounts. An account is either an asset account or a liability account or an equity account or revenue or expenses. Now, there are other, in the equity account, equity goes up when I sell shares, so common stock is recorded on the right-hand side. Equity goes down when I pay dividends. So dividends are recorded on the left hand. So there are your 5 categories of accounts. Every account that is in the records of a business is either an asset account, a liability account, an equity account, a revenue account, or an expense account. Now, revenue is easy. It always increases on the left side, on the right side. It never decreases. Expenses are easy. Always on the debit side, you never credit an expense. You never debit revenue. If an asset increases, you debit it. If it decreases, you credit it. All right? And that's the whole thing. Again, visually, assets increase with a debit, decrease with a credit. Liabilities increase with a credit, decrease with a debit. Equity increases with a credit, decreases with a debit. You can remember that because assets, notice, is on the left-hand side of that equal sign. All the other, the liability and equity accounts are on the right-hand side. And that's all you have to do to remember. So now, think of all these asset accounts as T accounts. All right? If it's an asset, it will increase as a debit, decrease as a credit. If the transaction affects a liability account, the liability account will increase as a credit. Or if there's a decrease in the liability account. If I sell shared capital, well, it's only a credit. I don't often sell shared capital. I sell shared capital, but I get the money, but I don't give back the money. Retain earnings, dividends, revenue. Now, keep in mind the rule. Every transaction will affect 2 accounts. Could affect 3 or 4. But the debits will equal the credits at all times. When we did analyzing the transactions, you analyze the transactions by saying increase and decrease, but you were always in balance. But by using the debits and credits, if you record the transaction properly, the debits will equal the credits. All right, let's see what we've got. A debit to an asset account indicates good. Right? Now, pardon? Debits. Very good. Yes, it increases assets, but it decreases liability. So you see, a debit doesn't mean increase or decrease. A credit doesn't mean increase or decrease. A debit to an asset account means an increase. A debit to a liability account means a decrease. But by itself, debits and credits only mean left and right. The normal balance of any account yes, very good. The normal balance of any account is the side which increases that account. So if it's an asset account, it increases on the debit side. Normal balance for an asset is a debit balance. It's a liability account, it increases on the credit side, and the normal balance of a liability is a credit balance. A revenue account. Oh, good, yeah. Only increases on the credit side, so remember that. All right, it never decreases. So you never debit revenue, you only credit revenue. And which accounts normally have credit balances? Revenues, liabilities, and dividends. Revenues, liabilities, and retained earnings. Now, yeah, very good. It's the right answer. The account will have a credit balance if good, everyone's answered. Very good. Working together as a class, so we gotta get on. You know, as your class, you maybe put your phones up. I don't want to do that. Your pen is free and you just want to multitask on your phone. But you're going to have to pass this course, so you want to continue. All right. So. Doctor, investigation. Depreciation. 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 What is depreciation? Look. What is depreciation? It's only 5 accounts. Asset, liability, equity, revenue, or expense. What's depreciation? It's an expense. So now, how does it increase? It's not here. Module 4, right at the bottom, activities. Right at the bottom. Okay, Aaron, keep going. No? Yeah. Every time you see the word revenue, credit. Except unearned revenue. But unearned revenue is also a credit because it's a liability. Okay, all right. Okay, prepaid insurance is an asset. Accumulated depreciation is a credit. Now that's a tricky, I haven't introduced accumulated depreciation, so it's opposite the asset. Okay, very good. Any questions? All right, number 2. Now, not only tell me where this account is a debit account or a credit account, tell me if it goes to the balance sheet or the income statement or the retained earnings.
It's the same thing. And every time. Yeah.
Okay. Common stock, credit, good. Balance sheet, good. How come you're not doing your own? Oh, I see. Are you sharing on one tuition? You're gonna get together and have one month? Why do I say soup? Just a report. Yeah. This one. That's another thing to say. The word credit in English means, good or bad. I have no credit, I have good. It doesn't mean anything to us, it simply means light side. See, it's come down in the language about credit. You know why? Because the bank is going to lend you money, and when they lend you money, they have an asset, you've got a liability. So you got credit, which means I'm letting you borrow money. Because for you, you're a credit. You're a debtor. Capisci? Capisci is old Italian for it. Taking pictures ain't gonna help him. Good. Okay, go back. Did you get everything, Yara? Anybody have any questions? Very good. Okay, let's go. We practice and we practice. Okay, each match these words. Yes.
No, I'm just thinking.
I thought you had a good understanding. Let's go over here. You got your balance sheet and income statement? Remember that song? That'll be on right there. Don't screw it up this time. I know. You gotta know what's a debit, you gotta know what's a credit.
Sometimes, we need to do stuff.
Exactly, that's why I take the phone out of your hand. You gotta plug in your ear, you can't multitask. Okay, all right, you skipped this one, why? A record of all accounts maintained by the company, okay? That is called, no, go back, chart of accounts. That's not fair, I haven't taught you that, but that's okay. You're learning now. Okay, what's the next one? Any other? If you're not sure, skip it and I will answer it for you. That doesn't mean you skipped them all. Now, later on, you'll see that we give each one of these accounts a number. And I'll introduce you what's called a chart of accounts. When you go into an account, if you're working an account, look the account, you show us the chart of accounts. I'll show you a list of all the accounts that use their account. And the numbers. A list of names. A list of names of the company accounts. No, not a chart of accounts.
Ledger.
Ledger, yeah. Good. The right side of an account, you should get that? Right. All right. The left side of the account. Events that require recording in the accounting.
Characters.
All right, good. Okay, last one. No. Oh, yeah, okay, good. Good, you're up. Should be good. Let's see what you got. What's that? The record of accounts maintained by a company. Oh, okay. Chart of accounts. I gave you the wrong answer, didn't I? The journal. Put the journal. For this one, put the journal. Right. Okay. A list of the names of the account. Okay, that with chart of accounts. Right. And the procedure of transferring from the journal to there with posting. Now, I haven't taught you the journal and the ledger, so you're getting a little bit of the language now. Good. You all right? Okay, that's the next one. There you go. More debits, more credits. Are you giving up already? Are you the one that came in 45 minutes late? And you're leaving half hour early? And you want me to mark you as being here? Boy, what happened? Where's it going? Okay, number 4. An increase in supplies. Good. Supplies is an asset. Simply ask yourself, is this an asset, a liability, equity, revenue, or expense? It's only an equity if it's dividends or common stock. So all you have to deal with now is it's an asset, liability, revenue, or expense. If it's not common stock. All right. Hey, good. More. Just practice. Believe me, all you need to do is keep practicing this stuff. Memorize. And it's a piece of cake. Now, I haven't taught you how to record in the journal yet, but that's no big deal. I just want you to practice the debits and credits today before the break. I don't want to give you all that stuff. After the break, you'll figure it out. We just practiced, so that's all. This is the easiest question. If you were to participate just in class. Okay. Okay, go ahead. Okay. What do you got here? You got a lot. Now look, expenses, you only debit. Okay. Revenue, you only credit. There's never a decrease in revenue. There's never a decrease in expenses. Accounts receivable, a debit will increase it and a credit will decrease it. All right, down here, notes payable is a liability. A credit will increase it, a debit will decrease it. And expense, you only debit. Now just remember that. Again. Here you put in, okay, bonds payable. Will it increase or decrease on the debit side? Very good. On the credit side, and what kind of balance will it have? Right. Good. Unearned service revenue is a liability. Remember, I explained that. So it will decrease on the debit, and the liability will increase. Depreciation expense. Every time you see the word expense, it's a debit. Every time you see the word revenue, it's a credit, unless it's unearned revenue. But even unearned revenue is a credit because it's a liability. But revenue, earned revenue, it is the. Your girlfriend's phone. The bank manager wants to. All right. Very good. All right. All right. Anytime you see revenue, it's a credit. Right. Good. Okay, now you have some transaction. Issued common shares. I issued common shares for cash. So what account is debited? Which account increases? Cash, right? Which account is credited? Well, which two accounts are affected? Common stock, cash. Right. June 2nd, I buy equipment. Remember your transactions last time? Oh, we don't say increase and decrease. We say debit and credit. Okay. All right. Okay, no. Oh, I bought it on account. So you're right. Accounts payable. Right. Accounts payable goes up, credit. Equipment goes up, debit. I paid $7,000 for rent. What's rent? Asset, liability, revenue, or expense? Expense. So it's always debited. And what did I pay? Cash. Right. I sent Wilson a bill, so I did work, and I'm gonna get, yeah, he owes me, and when I do the job, I always credit revenue. Very good. Okay. All right. 8. There we go. Now, okay? Now, what you do is you put the name of the account here and you debit or credit. So, issued common stock in exchange for 4,900. What two accounts were affected? Now, when you record, you always record the account that is debited first. Which is? What's the account that's debited? Right. Okay, now put the debit in. How much? Now you're learning how to record. Right. 4,900. Which account is credited? Look at the transaction. Which two accounts? Yeah, so which account is credited? Right. And you put it on the credit. No, on the credit, yeah. There, you recorded the journal entry. That's it. That's all you have to do. Now, buy equipment. You just did these before. Buy equipment on account. Which two accounts? All right, and credit, accounts payable, very good, Yara. All right. So number 3, you paid a rent. Always. Right, rent expense. You just have to type in a little bit and I'll give you, put the amount in, and cash. Very good. Then I earned revenue, and I sent the guy a bill, which means I didn't get cash, which means he's going to pay me later, which means my records, accounts, receivable amount. And I don't have some. Revenue, you earn revenue, cash receivable, every time you work, revenue, credit. Yeah. Easy. No. Look, credit revenue. Now, did I get cash? No, not cash receivable. Right. Okay. No. You never debit revenue. You always credit revenue. The debit is either cash, I got the cash, or he's going to pay me later. It's cash receivable. Yeah. Yara. Okay, okay. Good. Okay, now notice these transactions begin to repeat themselves. Issued shares for cash. No, I'm sorry, purchase supplies. No. Oh, wait. When I buy supplies, that's an asset. So the debit is supplies, not supplies expense. Right. And the credit is, did I buy on account? No, cash. Okay. Now, I paid cash to the shareholders. Shareholders, so this is dividend. Dividend reduces shareholders' equity. So it's on the debit side. So debit dividends. And what did I pay them? Credit. Debits equal credit all the time. Okay, good. Now, I received $4,800 down payment for a customer for services to be provided later. This I received, what did I receive? That's an asset, it's a debit. Now, I have a liability to perform these services. This liability is called unearned service revenue. Right. Now that's a liability, even though it has the word revenue in it. It's not a revenue account. Then I received cash from somebody who owed me. If they owed me, I have that person in my accounts receivable. Now they pay me cash, I reduce my accounts receivable. So the debit is cash and the credit is right. When I credit my accounts receivable, it goes down. Very good. Okay, the next transaction has 3 accounts. All right, it always has at least 2, but it has, this one has 3, but the debits always equal the credits. So, I purchased equipment, good. I paid cash, credit cash, and issued a note, notes payable, very good, very good. Notice the debits equal the credits. See how easy this is?
So we add them so we get one mistake.
Okay.
We add them together so we get
Cash, the rest is not. Cash is credit, those two are the debit. Did I buy a cup? Right. No, that cash goes on the credit side. Right. Equipment goes up, cash goes down, and notes payable goes up. How does it go up? On the credit side. Now notice, the credit to cash and the credit to notes payable equal price of the equipment. Okay? Very good. Yes. Number 10. More. But very easy now. Notice they're going to repeat themselves. Issued shares. Issued shares. Paid insurance. Performed a service. Issued shares. What did I get?
Yeah, that's a component.
Right. And what did I give them? Common stock. Good. Gary, see how easy once again? Repeat. All right. Paid the insurance advance. No, okay. No. This is prepaid insurance. If I pay in advance, it's prepaid insurance. And what did I pay with? Right. Okay, good. Now, I perform service, so I receive money every time I perform service. You credit. I either debit cash or I debit accounts receivable. Right. There you go, you're really cooking now. You don't need help anymore. Okay, what's that? Pay the secretary. So that would be wages or salaries. And what did I pay her? Good. Very good. See how easier it gets the more you do them? All right, this is a trial balance. Now, what you do is you put in these accounts and you put the balance. Now, if everything is right, the debits will equal the credits. So, put trial balance as of June 30th. Put the heading in. Okay. Accounts payable, debit or credit? Okay, put it on the credit side. You said credit, didn't you?
Just see the different credits.
Accounts payable. It's a liability account, so it has a credit balance. Cash.
This last one.
What kind of balance does it have? No. What kind of balance is an asset account?
Debit balance.
Right. Okay. Common stock. Common stock. What kind of balance does the equity account have? Debit or credit? Credit, yeah. Dividends. Dividends only have a debit balance. Okay, equipment. It's an asset account, so therefore debit balance. Debit, yeah. Asset. Okay, revenue. Revenue only has credit balance. Accounts receivable. Right. No, accounts receivable is an asset account. If it's an asset, it's on the debit side. If it's a liability, it's on the credit side. If it's revenue, it's on the credit. If it's expense, it's on the debit. Right? And rent. Now, if you've done everything right, and these are the account balances, the debits should equal the credits. So add them up now.
We have no beach. Also,
Add to the equal. Very good. That's it. Very good. Yara, thank you very much for sharing.